what is the level of inflation that you're looking at then? Keeping in mind that the CPI print, at least on paper, has been coming down steadily since last year, and one would have to consider that going into recessions. Every single prior recession going back the last 7 years, seen the inflation rate go down during the course of the recession. So I'm curious as to see how elevated you think this would be in this stagflation.
So I think right now, in the next several months, we've been in a disinflationary cycle. I think we're going to continue to be in a disinflationary cycle. Now, in the 70s, for example, you would have inflation come down from a high level to a level that is still pretty high. Inflation doesn't always go low in recession. It just always, historically in the U.S. always goes lower. If you look at internationally, if you look at when you see emerging markets have recessions, sometimes they have a massive inflation breakout during recession because their currency works differently, right? Because they have liabilities that they can print, and therefore they tend to experience different types of recessions. One thing that makes this period interesting is that there are tighter energy constraints now, and so you could have environments where Europe and the United States almost experience like an emerging market type of recession. That's more of a stagflationary type of recession where on the demand side you are experiencing a degree of disinflation, but it's not as though you're now completely oversupplied with commodities and all those things get super cheap. They could still be somewhat elevated in price while you have ongoing economic contraction, stagnation, things like that. So, again, giving an exact number is partially depending on human policymakers, but the way I would phrase it is that the constraints that are causing inflation to contribute to inflation are still there. And so all the money that was printed is still mostly in the economy, especially now that I think we're getting towards the end of quantitative tightening. That removed some money that was printed, but only a small portion of it. Most of the money that was printed is still out there. We still have not had really a CapEx cycle in energy or commodities. We've not brought new copper mines online at scale. We've not brought new oil fields online at scale. We're seeing some obviously development around LNG export capacity to, for example, reduce Europe's reliance on, now that they've been severed from Russia, they need more LNG. So obviously there's work being done, but I think the world is still relatively tight on the supply side. And so if you see China really ramp up and fully reopen in terms of international flights and things like that, and if you see, just general more economic activity throughout the world, you can certainly have an environment where oil is back over $100, for example, while you have economic softness. I mean, if you look at 2008, for example, oil was spiking kind of at the early stages of that recession. It was actually in some ways contributing to that recession. And so the timing doesn't always work out the way we expect. So the way I look at it is that if we're willing to go into a recession, we can certainly get inflation down for periods of time. And the question is, when we try to accelerate out of that recession, when we try to have another growth cycle, I think the problem is that inflation, the conditions are still there to reignite another inflation wave. So inflation came in waves in the 70s, it came in waves in the 40s, and I think it's going to come in waves in the 2020s. Even if I wouldn't try to predict the exact lows and the highs, I'm more trying to look at the conditions and expect the direction.
I had a call from a friend last night, and he's not an economist. He doesn't know much about finance. He's a lawyer, actually. And we explain in layman terms, Lyn, this coming recession, you said it's not going to be a complete deflationary collapse. To somebody who's not working in finance, explain to him how bad or okay this next downturn could be. And the thing I told him is that, dude, you got to understand, recessions are normal parts of the business cycle. It's just a matter of how severe it could be. So how severe is this going to be? How is this going to impact the everyday person?
So I think that's, again, going to depend on policymakers. The challenge is, so recessions, as you point out, are normal. It's normal for periods of excess to get wiped out, to take out businesses that are not really being productive. That frees people up, frees resources up to go do something more productive, figure out something new. And so that's completely normal. It also, wipes out bad debt from the system. The problem is that everything is so over levered now. And more importantly, leverage has gone up to the sovereign level. So what made 2008, for example, such a deep recession is that you had built up private sector debt for decades, and then that rolled over. A lot of that was then put onto the sovereign level. Basically, we somewhat de-lever the private sector. We put a lot of it onto the public sector. The problem now is that a lot of it's already on the public sector, and that tends to be a more inflationary scenario because they're still running. If you picture 2008. They were doing these like large rescue packages that were like, $700 billion. Whereas in the current environment, the deficits are like double that going forward on an annual basis. I mean, it's like the baseline deficit now is like 1.5 trillion. And to the extent that the Fed is eventually forced to resume monetizing it, which you might have partially seen over the past month with, they're still doing quantitative tightening, but now they're actually adding more liquidity into the system than they're taking out. And so if you get back to a period of monetized large fiscal deficits of that scale, in some ways that's like a stimulus. But the problem is that it's an inflationary stimulus. And so on one hand, you have contractions in, I am concerned about commercial real estate. I would not really want to be working in, a fund that finances office space, for example. I wouldn't want to be in an unprofitable tech company. There are certain areas that I think are quite vulnerable. But when you zoom out, that's somewhat balanced by the fact that they're just doing these ongoing deficits that are just pouring more money into the economy. And so that's why I think it's a more stagflationary type recession. I think if you work in travel, I think if you work in, if you're a welder, if you're a plumber, I mean, a lot of these people are now making really good salaries because they're still in short supply and they're somewhat recession resistant. So I really think that the severity of the recession is going to depend on type of work you do, your role in the economy, and what type of assets you own. But in general, I expect it to be a more stagflationary type of recession, and one where inflation's ready to return as soon as policymakers are willing to try to get us out of that recession.
S&P 500, is it a continuation of a long-term secular bull run going back to the mid 2000s, or are we going to see what some people are saying could be the start of a new wave of crashes?
So my base case is that the 2020s decade will not be a good one for equities, especially in inflation-adjusted terms. It's not necessarily that I'm expecting crashes, although they're certainly possible. It's more like when we're looking back from the late 2020s or we're looking back from 2030. I just think it's not going to be a very good decade. But when the treasuries came down all the way to like sub 1%, people were willing to pay almost anything for an equity because it's still has better forward return prospects than a super low yielding treasury. But now that we're kind of in a regime where treasuries and interest rates have really hit the floor, and now they're in this more sideways to up type of environment, that tailwind of ever higher equity valuations. And so they're more going to trade in line with their earnings. And so I certainly think you can see a period where, especially in inflation adjusted terms, the major large cap indices just kind of chop around in a band for 5+ years, which is quite common, unfortunately, among global equity markets. The U.S. has been kind of an exception for the past 40 years. We've had among the strongest markets, but I think that trend is probably over, and now we're looking at more. It depends on the stock you're in, depends on the sector you're in. But I think that the big indices are not in great shape. And another factor is that, you can look at all these valuation metrics, but one of my favorite ones is to look at household allocation to different types of assets. And when the stock market peaked in late 2021, U.S. households had a record percentage of their assets in equities.
Your thesis that lower, I guess, risk-adjusted trade-off for going into equities because of higher interest rates. That your assumption is that the end of zero interest rates is here, right? We're never going back to zero.
I think even if we go back to zero, I mean, so my guess would be no. But even if we do, let's say we have a big, massive commercial real estate crash, and the Fed cuts interest rates to zero. The point is, we're not going lower and lower. We're not going from 0 to -2% or -3% or -4%, right? We've had, not only have we had a period of low rates, we've had a period of ever lower rates. And so now, even if we just stay at 0, or, we bounce between 0 and 5, for the next decade, you might have equity valuations remain high, but the point is they're not going ever higher. And so even if you have high equity valuations on earnings, you're still trading in line with earnings. Now, if you get interest rates go steadily upward, then you probably get some degree of earnings, valuation contraction on top of earnings. So there's a range there, but really I think the tale of just ever higher valuations is behind us.